Hey everyone, this is John and Drew Creekmur here from Creekmur Wealth, and in this week's rundown, we got some really exciting topics that we're gonna run through here, kind of recap some major stories that came out this week and how it really affects you, your finances, and you guys achieving your long-term financial goals. And so, John, how you doing this week? It's been kind of a crazy one, hasn't it?
I'll tell you, it's been a great week, crazy week, a lot of stuff moving around, a lot of stuff in the news. Most importantly, Major League Baseball starts on Thursday this week, and so no matter what's happening in the world, baseball's back. It's a new day, right?
It's a
Uh,
new day. Hey, who are you picking in the National League Central there? Are you picking the Cardinals or the Cubs?
every year I have to pick the Cardinals because they are, obviously it's the best fans in baseball, or so they like to say. But it's one of these things that when that's your local team, that's who you have to cheer for, no matter how good or bad they are.
Right, right. You just got to cry, laugh through the pain sometimes
Yep.
as you're watching those games. So, but yeah, exciting day, opening day MLB. So we'll see what happens this year.
It's one of
And
the things too. Whenever I kind of think about crying through the pain, I've had a number of conversations lately with some folks in their portfolios. They have their favorite stocks or their favorite ETFs, and they've been crying through the pain lately because these are folks I talk to on the street and folks that call in from a podcast or a radio or from a something where they saw me speak, and it's like, man, I love this thing. I was killing it last year, and all of a sudden, then they've lost 10% this year. Now they're crying through the pain, trying to figure out what to do. And we hope that folks that we talk to regularly and that follow principles that are sound investing principles, they're not crying too much in the midst of all the change going on.
all right, right. You can't allow the short-term fluctuations to kind of knock you off track for achieving those long-term goals, as difficult as that may be sometimes, for sure.
For sure.
And in the market, I mean, we've seen a lot of correlation. I think that's kind of playing into some of that pain that people maybe are experiencing, where the market's kind of bouncing all over the place. If bond yields go up one day, the Dow Jones will go up, but the Nasdaq will go down big, which is kind of a reversal from what we saw last year, where the Nasdaq was just ripping, but the Dow Jones was down. And how does correlation in markets really affect people's portfolios, John?
Hmm. Well, that's an interesting question because we see things that in the past they were not directly correlated. So people would say, "Hey, I'm going to diversify my investments. I'm going to have a certain percentage in stocks, a certain percentage in bonds, some in growth stocks, some in value stocks, and I'll be diversified." And then whatever one goes up, the other goes down. So it kind of smooths the ride out. Well, it's interesting. To way back in 2008, this is 13 years ago. And so I've made it a point, though, to try to keep my haircut short because then folks can't see my gray hair. It's a vanity in me. But, you know, but that's kind of age when I say, Drew, back in 2008,
Back in the day.
back in the day. But so we laugh at those things. But it does give perspective that just about every single asset class in 2008 moved in the same direction, which was down in value. And so the things that were historically not correlated, so correlation means they move, a simple term, a simple definition, do they move at the same way at the same time? And so they're
Right.
correlated. And then if they move in different directions, one's up, one's down, well, then they're not correlated. Well, we see a lot of things that are correlated in the past that maybe were not necessarily correlated. But one of the things we're seeing right now is a huge shifting dynamic overall in the marketplace, as well as the economic world. A lot of that, quite honestly, a lot of the change we're seeing has been brought about in the last year and a half, with the way the markets and the economy naturally moves, has been adjusting. It's been manipulated or been influenced by large government interactions and stopping economies and starting economies and throwing a bunch of money in and taking money out, buying bonds and selling bonds from the governmental thing structure. Well, then all of a sudden, then man, that influences how things are correlated together and how they're moving together. You brought up a great point. We're seeing the federal government. We just had $1.9 trillion stimulus plan passed, and now President Biden is talking about what, a $3 or $4 trillion infrastructure bill, and next phase on the COVID stimulus, another $2 or $3 trillion there. So we're talking trillions of dollars left and right, and so all that's flooding the system. At the same time, we have the largest amount of cash in the system now, even before the last stimulus package, and
Hmm.
we have economies opening up. So there's concern inflation is going to take off. And so interest rates on bonds have been moving up. And in some ways, I mean, in one day, it went from 1.4% on the 10-year to 1.62% on the 10-year. You
Right.
might think, man, that's nothing. 10 years is only a 0.22% difference in a day. Well, man, that's a 15% increase in yields. And so what happened? That totally killed the technology stocks in the NASDAQ. So in a lot of ways, we're seeing an anti-correlation movement.
Right. Well, and whenever things aren't working the way they have in the past, that's kind of where it's important to have a well diversified strategy and a time proven strategy when you're looking to manage your investments. So you don't give into those emotions where you're crying through the pain, right? That we were talking about earlier. For us, what do we base that around and when we're managing our clients' assets for them?
Yeah, that's a great question. So we're looking at two different things. And so we look at basically movement, and then we're also looking at macro trends. So
Right.
let's talk macro first. So macro is big stuff that's happened, whereas micro is smaller stuff that's happened. But on the macro, we're looking at the overall economy. We're looking at geopolitical events. We're looking at huge movements societally, not just in the US, but around the world, and how are things connected. And so we're looking at those things and saying, we're seeing this huge amount of stimulus coming in from the federal government. At the same time, it's not just the U.S. government, but as all the countries around the world are navigating this, a large amount of dollars in, and we're seeing unemployment numbers moving in the right direction, so more people working, and we see a large amount of cash from all the dollars given to people and sitting inside their savings accounts. That's going to get put to work, and all of a sudden the economy is going to start to stimulate or grow faster and faster. Well, then that's going to give us some direction on where to be investing money macro in the big areas. So maybe then we decrease our investment in bonds, or maybe we increase investments in certain areas that have more growth oriented. So that's more of a big picture. Or we see something with China and the U.S. getting into a fight over a trade
Right.
bill. Well, that might affect things. Or we see the Australian dollar moving down in a direction. Well, that's really an indicator of what's happening in the Chinese economy. Well, so those things do influence the macro movements, how much really we have in stocks and bonds and U.S. international things like that. On the micro, though, what we're looking at, guys, is we're looking to say, let's say relative to the S&P 500, so the broad-based U.S. stock market. Within the S&P 500, there's 11 industry groupings. So that would be like technology is one, or financial services is one, or pharmaceutical healthcare is one. But within each of those industry areas, those 11 industry areas, there's actually sub areas. And so within technology, there's semiconductors. Well, also that right there, is a different, smaller micro segment. So what we're looking at is we're saying of all those different areas, and right now it's about 300 we track, how are they moving up and down relative to the S&P 500? And if they're moving up relative to the S&P 500, S&P 500 is up, this area industry grouping is up, well, then is it moving up at a faster pace? And we notice that from volume as far as number of shares that are being purchased. We're also looking at the price move of the stocks. The ones that are moving up at a faster pace, have more momentum, those are the ones to get your money in front of whenever things are moving on an upward motion.
Yep. So what we're trying to do there with the macro and the micro is we're trying to identify the micro trend and then use the the macro trend and then use the micro to confirm that as a positive trend where we want to invest our money with the hopeful and time proven result of decreasing your risk over time and getting your money ahead of those trends that John mentioned. And really, that's how we achieve long-term financial planning goals in the most efficient manner possible. And I know, John, you mentioned a macro is a huge thing that we track, and that helps us begin formulating ideas on where we're going to invest. We had a major macro event this week, and that was President Biden unveiling phase one of his infrastructure plan. They have only released the first part, which is about $2 trillion. Number of interesting things in the bill. What are just off the top, just kind of major key points that stood out to you during that introduction?
Yeah, so it's just interesting. We're seeing a lot of different things rolling out right now, and in that bill when it came out, the first one is that leading number. We're looking at $3 trillion, I believe, was the number, Drew, as far as in that transportation bill, as far as infrastructure. Well, the question is, how is that going to be paid? Where is that money coming from? So one option is to just go straight under the national debt. And so if that happens, that does affect interest rates, if we think about that. And so there's more debt that affects the interest rates that are out there. What else does it affect? Well, they're saying the way they're going to end up paying for it over time is by increasing corporate tax rates. And again, remember, under President Trump, corporate tax rates decreased down to 21% from the low 30s. And so what they're talking about is saying, let's increase the corporate tax rate from 21% to 28%. And so corporations will be paying for that. Well, then on the macro conversation, then that actually would impact. So if companies pay more in taxes, that means their after-tax earnings will be lower.
Right.
They have two choices. They either increase prices to what their end products going to the consumer, and so that's a trickle down, so that it causes inflation to happen, or they make less money. If they make less money, then what's going to happen to the value of those companies and ultimately their stock prices? So that's the macro side. On the micro side, we have to say what areas are we seriously developing in there. So and we do have an issue in our country. We relative to the rest of the world, we're falling behind as far as with our infrastructure, which would be everything from the roads, the bridges that we drive across. There's some bridges that I try to zip across real fast.
Close your eyes, right?
Right? You can see the concrete fall when you hit a bump, and it's just kind of scary to me. But or even like things such as our electrical system, our water delivery system. So we do have some issues there that, quite honestly, we've been neglected for many years. And Drew, kind of again telling my age, it's like every single time we have a change in presidency, there's always discussion about infrastructure bill and infrastructure, but no one ever conquers that. So we'll see how it plays out in time. But the electronic vehicle charging stations is an area that we're seeing. There was talk from Mr. Buttigieg about one way they're going to help pay for this is by having a per mile tax on the vehicles that we drive, unless they're electric. And so it's all different things like that we may see end up playing into it. But whenever we see that, we then have to say there's opportunities to make money. So whenever you see a news thing, you may disagree with that, and that's great. That's why we live in America, right? We can disagree and debate and have a great conversation, and then go out and get a hamburger and a Coke afterwards, and still be buzzed. That's the way it should be. And so we can look at that and we can say, I may not like it, but don't just rest there. Say, how can I make money in the midst of that? And that's what we're trying to do inside portfolios.
Yep. On the micro side, we're definitely looking, and we actually have holdings in the clean air, energy, infrastructure, materials, the areas that really are going to benefit from any public investment in those areas. If it does come to be in whatever form, we have made some micro movements. And, to that end, on the firm-wide side, John, we had a very large announcement for us. We're really excited about it. I think there's a ton of value add for our clients, and that was our rollout of Easy 401. Can you give us a high-level overview of what that is, why we built this program, and how people can learn more about it?
Yeah, from a high-level standpoint, Drew, the number one question we hear from clients every time we have meetings with people, so whether they're new to our firm, been with us for a while, as long as they're working, the number one question we have, no matter what it is we're working with them on, is someone says, hey, I need to get a little term insurance to take care of my family if I pass away. Oh yeah, by the way, and so they always say, can you help me make the investment decisions inside my workplace retirement plan? So if you have a 401k, if you have a not-for-profit like a hospital or maybe a school or a church, you have what's called a 403b. If you're a municipal employee, maybe you have a 457 plan. All the different letters and numbers, right? But it's your workplace retirement plan. Well, folks need help. It asks us for help in managing that 401k. Well, we've been working for probably the last couple of years on putting together a system in which we can do one of two things. We can give you trade signals in which you can go out and place the trades yourself in your 401k on a quarterly basis. And so we're watching the markets, we're updating those. There might be something urgent we send a mid-quarter, but it's pretty much on a quarterly. But then also we can begin right at this moment, right now, we can actively manage inside your 401k or 403b or 457 plan, regardless of where you work and regardless of what your investment options are, we can actively manage your portfolio for you. And it's a way of us saying, hey, let's look for highest quality investments that are properly aligned with your individual goal objectives and time horizons to make sure you're on the right path and you have confidence in that going forward. And Drew, I kind of chuckle and laugh, but it's a story we hear people say all the time. It's kind of like, I'd ask, how did you make your investment selection in your 401k? And the answer is one of two things. I don't know. I just talked to some guys over at the water cooler out the shop, or we're getting a beer afterwards, and they said, hey, you should look at this. So I did that. Or when I was signing up, the HR person or the company person says, well, most people do this. And so I did it, and then I put it in that way, and I forgot about it. Folks, that's not how, for most folks, this is their largest asset. Definitely the largest financial asset for almost everyone. You want to make sure you're managing it well. And Drew, I'm so pumped and excited that we have a tool now that we're getting rave reviews on, that people, everybody, no matter where you work, can actually have professional management of your 401k done with partnership with you, either where you execute the trades yourself or else where our team of financial planners and money managers can actually manage that for you. It's a huge resource available right now at easy401.com.
Yep. We're really excited about easy401.com. And, as we were building the program, came across a number of studies that showed that people that had professional management on their retirement plans saw an increase in their annualized return by somewhere in the range of 3 to 4% a year, which again doesn't sound like a ton, but when you start looking at compound interest, those dollars really start adding up, and it really justifies something that you maybe need to consider. So John, easy401.com, there's a form where you can submit hey, give me a call. I want to learn more about this. And one of your advisors will reach out to you and kind of walk you through what the program is, how it works, and whether it's the right fit for you. And so that is easy401.com. We're super excited about it. So John, any closing thoughts for us? Been a good episode here, fun week. Anything to keep front of mind as we go forward?
I'll tell you what, which mentioned early on is the first day on the 1st of April as far as with baseball, Major League Baseball starting up. And the one thing about baseball I love is it's a long season, 162 games. Is that right? Yeah,
Yep.
162 games. And so and it goes over, goodness, 6-7 months now. And so it's a long period of time. And things happen with the team, right? They win some games, they lose some games, somebody gets injured, you get a hot streak, you slow down. But at the end of the day, the team that is consistently applying, they're watching out for hurdles, they're watching out, make sure everyone is healthy, make sure people are performing well, they have a strong team. Typically in October, November, those are the teams you see in the playoffs and the teams that win the World Series. And it's the same way on investing, folks. We know ups and downs happen in the marketplace. That always is going to happen. It always has happened in over 30 years of managing money. That's the one constant, is that the markets move up and down. There's some days when you're really happy, other days where it's like, wow. And a lot of times it's out of your control. But you want to make sure you have the end game in mind, is to win the World Series, and whatever their goal objective is, that's retirement, whether that's putting kids in college, whether it is, buying another house somewhere, going on a trip, whatever it is. Keep that goal in mind and say, we're going to make sure we monitor, we partner with people, we have a great manager, and we are putting things in place to accomplish long-term goals. Keep the end game in mind whenever you're making your financial decisions.
Yep. Great advice. Definitely think long-term. Don't let those short-term fluctuations knock you off path. So guys, thank you for your time. We appreciate each and every one of you. If any questions were brought up by this episode, don't hesitate to shoot us an email or give us a call. We'd love to chat with you. That'll be all for us. Have a good one, guys.
Talk to you later.